Gold just broke through resistance. Silver moved in lockstep. And platinum? Platinum did something it hasn't done in 14 years. The headlines will tell you it's inflation. They'll say it's Fed policy. They'll point to geopolitical risk. But here's what they won't tell you. Central banks aren't buying gold because they fear inflation. They're buying it because they fear something far more structural. And the fact that all three metals move together, that's not correlation. That's confirmation of a monetary architecture starting to fracture. Welcome to Currency Archive. If you've been watching markets long enough to remember when a handshake meant something, when due diligence wasn't just a checkbox, then you know real analysis doesn't come with flashing lights and hype. This channel exists for those who make decisions that matter. Before we go further, if this kind of strategic clarity is valuable to you, I'd appreciate it if you'd subscribe. It helps us reach others who think like you do. And one more thing, drop a comment below and let me know, where in the world are you watching this from? I'm curious to know where serious minds are gathering. Now, let's talk about what just happened and what it actually means. The markets opened Thursday morning like any other day. Traders watched their screens, investors checked their portfolios, and then something extraordinary happened. Not one precious metal reached an all-time high, not two, but three. Gold, silver, and platinum, all three, simultaneously broke through resistance levels that analysts had been watching for months. The synchronized movement sent shockwaves through trading floors from New York to London to Hong Kong. Gold climbed to 4,122.90, up 1.85% in a single session. The yellow metal briefly touched $4,929.20 before settling just below that peak. Silver surged even more dramatically, rising 3.31% to reach $96 per ounce. It came within 29 cents of breaking the $97 barrier, a psychological threshold that would have seemed impossible just months earlier. But the real story was platinum. Platinum exploded upward by 6.16%, gaining $153 in a single trading day. The mainstream financial press rushed to explain what was happening. Reuters published their analysis within hours. Their explanation followed the familiar script that financial journalists have been using for decades. Geopolitical tensions, they wrote. A softer U.S. dollar, they added. Expectations of Federal Reserve interest rate cuts, they concluded. The narrative was clean. It was simple. It fit neatly into the framework that readers expected. But there was a problem. The narrative did not match reality. When someone examines the actual geopolitical landscape, the cracks in this explanation become obvious. Tensions with Greenland had actually eased. President Trump had announced a framework agreement for U.S. access to the island. Negotiations were progressing, not deteriorating. The tariff threats that had dominated headlines just weeks earlier were now off the table. In the Middle East, the situation was stabilizing, not escalating. A peace board had been established to address the Gaza conflict. Iran had gone quiet in recent days. The expected confrontations simply were not materializing. Even the Russia-Ukraine situation showed signs of progress. Meetings between President Zelensky and Trump had produced tangible results. Sources close to the negotiations suggested only one major sticking point remained before a potential peace agreement. This was de-escalation, not tension. So where were these geopolitical tensions that supposedly drove precious metals to record highs? They did not exist, not in the way the mainstream narrative suggested. The Federal Reserve explanation also fell apart under scrutiny. Yes, there were expectations of rate cuts later in the year, but the FedWatch tool, which tracks market expectations for central bank policy, showed something different. The majority of traders believed rates would remain unchanged for the next 3 meetings. Rate cuts were not imminent. They were not driving today's price action. This left a critical question hanging in the air. If geopolitical tensions were easing, if rate cuts were months away, if the traditional explanations did not hold water, then what was actually happening? The answer was hiding in plain sight. The US dollar index had collapsed. It dropped to 98.32, down 0.57% in a single session. This was not a minor fluctuation. This was a significant move in currency markets, where even small percentage changes represent billions of dollars in capital flows. While precious metals were surging, traditional equity markets were also rising. The Dow Jones was up, the Nasdaq was up, the S&P 500 was up. Everything was moving higher, except the dollar. This was the real story. Capital was fleeing the world's reserve currency. Peter Grant, vice president and senior metals strategist at Zaner Metals, acknowledged the broader trend. He noted that macroeconomic dollarization, weak dollar dynamics, and Federal Reserve policy expectations were all playing roles in gold demand. But even his analysis, while more sophisticated than the Reuters piece, missed what was happening in real time. The technical picture told a clearer story. Gold maintained a firmly bullish posture on the charts. Silver had broken into fresh technical buying territory. The March futures contracts showed prices that defied historical patterns. Basis pricing had become disconnected from spot markets in ways that suggested something structural was shifting. And then there was platinum. Platinum's supply chain had been fragile since 2022, even earlier if someone looked closely. The metal comes primarily from two regions, Siberia and South Africa. Neither region could be described as stable. Political instability, mining disruptions, and infrastructure challenges had created a supply situation that was precarious at best. Any small shift in demand could move platinum prices dramatically. Today's 6.16% surge suggested that small shift had arrived. The precious metals complex was not responding to headlines. It was not reacting to geopolitical theater or central bank speculation. Something deeper was happening, something structural. The synchronized movement of three different metals, each with different industrial uses, different supply dynamics, different market participants, pointed to a common underlying cause. That cause was not what the headlines claimed. And understanding what was really happening would require looking past the surface narrative into something far more significant. While analysts debated geopolitical narratives, the real story was unfolding in a market most people never watch, the currency market. The US dollar index, a measure of the greenback's strength against a basket of major currencies, was not just falling. It was crumbling in a way that revealed cracks in the foundation of the global monetary system. Thursday's drop to 98.32 was not an isolated event. It was part of a pattern that had been building for weeks. Each session brought new weakness. Each trading day revealed more capital flowing away from what had been considered the world's safest asset. This was not normal dollar volatility. This was something different. When precious metals move together, when gold and silver and platinum all surge simultaneously, it sends a specific signal to those who understand market mechanics. These three metals have different fundamental drivers. Gold is primarily a monetary asset. Silver straddles the line between monetary metal and industrial commodity. Platinum is overwhelmingly industrial, used in catalytic converters and other manufacturing applications. For all three to spike on the same day suggested a common factor overriding their individual supply-demand dynamics. That common factor was dollar rejection. The equity markets provided additional evidence. The Dow Jones Industrial Average was climbing. The Nasdaq was posting gains. The S&P 500 was pushing higher. In normal circumstances, when stocks rally strongly, precious metals typically consolidate or decline. Money flows into risk assets and away from safe havens. But Thursday was not normal. Stocks were rising and precious metals were exploding higher. Both asset classes were moving in the same direction simultaneously. This only happens when investors are fleeing a third asset, and that asset was the US dollar. Capital was searching for anywhere else to go. Some went into equities, some went into gold, some went into silver, some went into platinum. The destination mattered less than the departure point. Money was leaving dollar-denominated assets at a pace that defied conventional market relationships. Peter Grant from Zaner Metals touched on this dynamic when he mentioned macroeconomic dollarization trends. But even his analysis did not fully capture what was happening in real time. Dollarization is typically discussed as a long-term structural shift, something that unfolds over years or decades as countries reduce their reliance on the greenback for international trade and reserves. What was happening Thursday was something more immediate. This was not slow, gradual de-dollarization. This was active dollar avoidance. The technical buying in precious metals told its own story. When markets break through resistance levels on heavy volume with strong momentum, it attracts algorithmic traders and momentum-following funds. This creates a feedback loop. Higher prices trigger more buying, which pushes prices higher still, which triggers even more buying. Gold's move past $4,900 per ounce activated this mechanism. Silver's surge above $96 did the same. Platinum's explosive rise to $2,146 brought in technical buyers who had been waiting on the sidelines. But here is what made Thursday different from typical technical breakouts. The buying was not stopping. In normal technical rallies, metals become overbought. Indicators flash warning signals. Traders take profits. Prices consolidate before the next leg higher. This is how markets typically behave. Thursday showed no signs of consolidation, no pause, no pullback. The metals just kept climbing. Gold hit session highs near the close. Silver maintained its gains throughout the day. Platinum showed no signs of exhaustion even after a 6% single-day move. This kind of relentless buying pressure does not come from retail investors chasing momentum. It comes from larger players positioning for something significant. The futures markets provided another piece of the puzzle. March silver futures showed pricing that had disconnected from spot markets. The basis, the difference between futures prices and physical spot prices, had widened in ways that suggested tightness in physical supply. This was not just paper trading. This was real metal changing hands. When futures prices rise faster than spot prices, it means someone needs to take delivery. They are not speculating on price movements. They are securing physical metal for future use. This kind of behavior appears when industrial users fear supply disruptions, or when institutional players prepare for currency system stress. Platinum's supply chain vulnerabilities made it particularly sensitive to this dynamic. Mining operations in Siberia face ongoing political complications. South African production has been hampered by infrastructure failures, power outages, and labor disputes. The two primary sources of global platinum supply were both operating under constraints that showed no signs of improving. Any increase in demand, whether from industrial users stockpiling or from monetary buyers seeking alternatives to currencies, would hit a supply wall immediately. Thursday's price action suggested that wall was being tested. The Reuters narrative about geopolitical tensions and Federal Reserve policy completely missed this reality. Those factors were not driving prices. They were background noise. The real story was unfolding in currency markets and physical metal supply chains. There is a moment in every market cycle when traditional analysis breaks down, when the rules that governed price movements for decades suddenly stop applying, when experienced traders look at their screens and realize the patterns they trusted no longer work. Thursday was that moment for precious metals. Silver's behavior revealed the fracture most clearly. The white metal had climbed to 96.31 per ounce, a price that would have seemed absurd just months earlier. It came within 29 cents of touching 97, but the number itself was less important than how it got there. Silver had surged 3.31% in a single session. This was not gradual accumulation. This was not patient buying by investors slowly building positions. This was aggressive, urgent purchasing that overwhelmed the sell side of the market. Peter Grant from Zahner Metals made an observation that cut through the noise. He noted that silver had developed a far more compelling fundamental narrative than gold. This was a remarkable statement. Gold has always been the primary monetary metal. Gold is what central banks hold. Gold is what appears on balance sheets as a reserve asset. Silver has never carried that same institutional weight. Yet Grant was suggesting silver's story had become more powerful than gold's. Why would a metals strategist make such a claim? Because silver occupies a unique position that gold does not. It benefits from safe haven flows during currency stress, just like gold. But it also has industrial applications that create genuine physical demand independent of monetary concerns. When both drivers activate simultaneously, silver becomes something different. It transforms from a precious metal into a critical resource, with limited supply and unlimited monetary appeal. Thursday showed both drivers firing at maximum intensity. The dollar weakness was pushing monetary buyers into silver. The technical breakout was bringing in momentum traders. And beneath it all, industrial users were quietly securing supply for manufacturing needs that could not be postponed. This created a perfect storm of demand meeting constrained supply. Gold's inflation-adjusted performance added another layer to the story. When prices are adjusted for purchasing power, when someone accounts for how much a dollar actually buys compared to previous decades, gold was not just reaching new highs, it was demolishing previous records, by margins that defied historical comparisons. This was not a nominal price rally. This was real purchasing power flowing into physical metal at a pace that suggested something fundamental had shifted in how investors viewed currency risk. But platinum was the anomaly that demanded explanation. A 6.16% move in a single day. A gain of $153, a close at $2,646 after touching $2,650 intraday. These were not the kind of numbers platinum typically produced. The white metals market is smaller than gold's. Its industrial applications are more specialized. Its price movements are usually more subdued. Thursday's explosion higher broke every pattern. Platinum's supply situation had been fragile since 2022. The metal comes almost entirely from two regions that are among the most unstable on Earth. Siberian production operates under the shadow of international sanctions and geopolitical isolation. South African mines struggle with power infrastructure that fails regularly, labor disputes that shut down operations for weeks, and political uncertainty that makes long-term planning nearly impossible. This supply vulnerability had been known for years. Market participants understood the risks. But understanding a risk and seeing it manifest are two different things. Thursday suggested the manifestation had begun. When platinum moves 6% in a single session, while gold and silver are also surging, it signals that buyers are not being selective. They are not carefully weighing which metal offers the best value or the most compelling fundamental case. They are buying everything available because the alternative, holding currency, has become unacceptable. This is not investment behavior. This is preservation behavior. The equity market's simultaneous rise created a paradox that traditional portfolio theory could not explain. Stocks and precious metals are supposed to move inversely. When investors embrace risk and buy equities, they typically sell safe havens like gold. When they fear uncertainty and buy gold, they typically sell stocks. Thursday saw both asset classes rising together. The Dow, Nasdaq, and S&P 500 all posted gains while precious metals hit record highs. This only happens when a third variable enters the equation, a variable more powerful than the traditional risk-on, risk-off framework. That variable was currency rejection. Investors were not choosing between stocks and metals. They were choosing both over dollars. The capital was not rotating from one asset class to another. It was fleeing the monetary system entirely, searching for any store of value that was not dependent on central bank credibility. The technical indicators confirmed what the price action was showing. Gold remained in a firmly bullish posture with no signs of exhaustion. Silver had broken into fresh buying territory with momentum accelerating rather than fading. Platinum showed the kind of vertical price movement typically associated with supply shocks or major news events. But there was no news event. There was only the quiet exodus from the world's reserve currency and the scrambling rush into anything tangible. Every major market shift leaves clues for those willing to read them. Thursday's precious metals explosion was not just about price movements. It was a message written in market language, a warning signal that something structural was beginning to fracture beneath the surface of financial stability. The question was whether anyone was listening. Analysts who understood technical patterns saw something unsettling in the charts. Markets that reach extreme overbought conditions typically pause. They consolidate. They give traders a chance to take profits before the next move higher. This is normal market behavior, the natural rhythm of buying and selling that creates sustainable trends. But nothing about Thursday was following normal rhythms. Gold, silver, and platinum were all deeply overbought by every conventional measure. The relative strength index was flashing warnings. Moving averages were stretched beyond historical norms. Every technical indicator suggested these metals should pause, pull back, and reset before continuing higher. Instead, they kept climbing. This kind of relentless buying pressure reveals something about market psychology. When traders ignore overbought signals and continue purchasing regardless of price, it means they are not buying to profit from future price appreciation. They are buying because they need to own the asset now, regardless of cost. This is not speculative behavior. This is protective behavior. The futures market data supported this interpretation. Basis pricing, the relationship between spot prices and futures contracts, had widened in ways that indicated physical tightness. March silver futures were trading at premiums that suggested actual metal was becoming harder to acquire. This was not paper speculation driving prices. This was physical demand overwhelming available supply. When physical markets tighten while paper markets surge, it creates a dangerous dynamic. It means the price discovery mechanism that normally keeps futures and spot prices aligned is breaking down. It means the financial markets are disconnecting from the physical reality of actual metal changing hands. Platinum's supply chain vulnerabilities made this dynamic even more pronounced. The metal's primary production sources, Siberia and South Africa, were both operating under constraints that showed no signs of improving. Russian sanctions limited Siberian output's access to Western markets. South African mining operations faced infrastructure failures that had been worsening for years. Political instability in both regions was not a temporary concern. It was a permanent feature of platinum's supply landscape. Any buyer who needed platinum for industrial applications, for catalytic converters in automobiles, for chemical processing equipment, for electronics manufacturing, faced a choice. They could wait and hope supply chains stabilized, or they could secure metal now, regardless of price, to ensure production continuity. Thursday's 16% surge suggested industrial buyers had made their choice. They were securing supply while it was still available. The Federal Reserve policy expectations added another dimension to the market dynamics. Yes, traders anticipated rate cuts later in the year. Projections pointed to 2 quarter-point reductions in the latter half of 2025. But the FedWatch tool showed that expectations for the next 3 meetings were clear. Rates would remain unchanged. This meant the rate cut narrative, often cited as a driver for precious metals rallies, was not actually influencing Thursday's price action. The cuts were too far in the future. They were too uncertain. They were not driving real-time buying decisions. What was driving decisions was what traders could see happening now, the dollar index at 98.32. The relentless downward pressure on the world's reserve currency, the inability of traditional safe haven narratives to explain why stocks and metals were rising simultaneously. Peter Grant's observation about macroeconomic dollarization captured part of this reality, but even his analysis understated the urgency of what was unfolding. Dollarization is typically discussed as a gradual multi-year process as countries slowly reduce dependence on the greenback for international trade and reserve holdings. Thursday's market action suggested the process was no longer gradual. The synchronized surge across 3 different precious metals, each with unique supply dynamics, different industrial applications, and separate market participants, pointed to a singular underlying cause. Capital was searching for alternatives to currency exposure. It was flowing into any asset that offered tangible value, independent of central bank policies or government promises. Some analysts were predicting gold could reach $5,187 based on Fibonacci projections and historical patterns. Silver's fundamental narrative was being described as more compelling than gold's by institutional strategists. Platinum's supply constraints were creating price discovery problems that defied traditional market mechanisms, but the individual metal targets mattered less than what they collectively revealed. The markets were not betting on inflation. They were not speculating on geopolitical outcomes. They were not positioning for Federal Reserve policy shifts. They were preparing for something more fundamental, a loss of confidence in the currency system itself. Thursday's record highs in gold, silver, and platinum were not the end of a rally. They were markers on a road that was just beginning, a road that led somewhere the financial establishment was not yet willing to acknowledge. The question was not whether precious metals were overbought. The question was what happens when the buying does not stop.